Yo, what is going on, guys? Episode 72 of Many here. I've got a special guest today. We're going to talk about, we're going to dive a little bit deeper into like the finances stuff that I like to talk about. I know I've got a couple of episodes that we've discussed about credit cards and saving money and high yield savings and all these things. I figured it would be good for the podcast to bring on somebody who is in that field, knows a lot more about it, and we can dive deeper, give you guys some good intel, and hopefully you guys can take something away. So without further ado, we've got Jim Carriveau here. Thanks for coming on.
Okay. Thanks for having me. I'm glad to be here.
Jim is a local guy here. I actually met him over at the gym in Berlin. He likes to, well, he's in the financial advisor field, so I figured a local guy, somebody we could talk to, kind of pick his brain a little bit more. So that's what we're going to do today. So what I'd like to do to start, Jim, I want to talk about just like background, like what you're a financial advisor now, but what led you up to that point? What's kind of gotten you, why do you want to be a financial advisor? Like, let's just talk about that.
Sure. Went to high school in Berlin, went to college in lacrosse, played football there, got into the education program and was on track to be a teacher. And I took a personal finance class in college, absolutely loved it, loved every part of it, and told myself, I can't switch now because I've already spent all this money getting into the education program, don't want to extend my time in college, so I never pursued it and went into teaching. Taught for 18 years, coached football, wrestling, baseball, volleyball, softball. And then, opportunity came up 2019, talked with an advisor at Thrivent. We just happened to be golfing together. I wasn't really looking, but I always wondered if I could do this. And he said, hey, we're looking for somebody for our Ripon office. And I just kind of heard it. And then the next week I called him. I said, are you serious? And he said, yeah. And so he got me in touch with the local, I guess, the group vice president for Wisconsin, Michigan, had an interview with him in September of 2019. And then I didn't start, studying for the tests until March of 2020. If you remember, that was COVID, which was actually a blessing for me because we weren't in school. I'd had to be online with my students for about 2 hours a day. And then that gave me time to help my kids with their homework and then do some studying. So it was a long process. So it's not like most jobs where, hey, I want to go work at this job. 2 weeks later, you start there. This was March of 2020. It was study for 4 weeks, take a test. Study for 4 weeks, take a test. And I did that all the way until August, passed my final test. And then I started what they called at the time was Red Roll. So it was kind of an 8-week program to see if you can make it. And I did. And then, you're off and you're running, you're doing your own business. So very, very nerve-wracking. It's tough because the biggest change going from teaching is you knew every 2 weeks what you were getting paid. This business, you could get, you can make thousands and thousands of dollars one pay period, or you can get nothing. And when you got me, I made the switch when I had a wife, a mortgage, 3 kids. I mean, there's a lot of responsibilities versus being a 22-year-old kid that's living in mom's house. And
right.
So it was tough.
When you did the 4 weeks and then test and the 4 weeks and the test, that's just like your initial investment to even become a financial advisor. Yeah. Like that's like you proving like, hey, I really want to do this. Like you're not hired on by anybody. You're not getting paid for any of that stuff, right?
We did get paid after you passed the first test. It was like an insurance test.
Okay.
After I passed that one, then Thrivent started to pay me $15 an hour to study.
Sure. So
that was my job. That was my summer job. It was study 40 hours a week or more and then pass the test. And I was fortunate I passed all the tests on the first try, where some people, they don't. Yeah. And then that pushes you back. And maybe because the pressure was on, because I did have a family. I did have, responsibilities that there was probably more pressure for me to pass those tests.
Right. So I'm just curious from my own standpoint. They probably don't care as much, but so was it like you're under contract then, like right away, or like, just to take these tests and that kind of stuff? Did you like say, Thrivent, I'm going to do this? And then they said, okay, you have to go through this protocol, and like you kind of sign on with them? Like, how does that work? Because they start paying you after that first test or whatever. So I'm just curious.
It was more like an hourly employee.
Yeah.
They would, if I didn't pass those tests, I mean, they could have said, no, we're done with you.
What if you decided were these tests through Thrivent, or this just become a financial advisor? Because if you wanted to go with a different company, like how would that? like that's what my question.
Yeah, Thrivent was paying me to say eventually become an advisor for them, but I could very easily have gone to a different organization. It didn't have to be Thrivent after that.
Not that that'd be the right thing to do, but I'm just curious how that how that worked for you as a person. So like you could have done the test and you could have taken the money and then you could have been like, I'm going to go. Because I assume the test that you were taking was like just for a general financial advisor you could take that anywhere now and go work for another firm if you wanted to or whatever, right? Yes. Hypothetically speaking.
Yep.
So I was just curious on how that worked or whatever. So, okay. So financial advising, you just kind of, you took your one class, you really enjoyed it. 19 years goes by, you bumped into a guy at a golf course or you guys, was it a golf outing or something probably?
We were just golfing together, which, I mean, we didn't hang out a whole lot together. So how we were together, I don't remember why we were golfing together, but it just so happened. He asked me to golf and I did. And
a conversation.
Yeah.
Cool. So now we're doing financial advising. You've been doing it since like end of 2020 then, essentially?
Yes.
And so just to like, I'm curious again. So you are like your own boss, right?
Correct.
So when this guy approached you and he said, we need a guy for our Ripon office, it's just like a plug and play though? Like because you have to build your own clientele. Like is that how like the financial advisor business is for like anybody who's a financial advisor? Like they have their own book of business and that kind of stuff?
Yeah, for the most part in Thrivent, I mean, back when he started, you were kind of given a book of business where you're given a group of clients that you had to work with. And then you could still build your business. They were expanding into Ripon, so they're ideally looking for a Ripon person.
Sure.
And so I never went over. I went to Ripon a few times, but it just, my base was in Berlin,
Sure.
So that's where most of my clientele came from, that Berlin area. But with the digital age, I mean, we have clients all over the country, so you don't have to be in the same town as them.
People can work for you though, like since you've got your own business, can you hire an employee underneath you and like?
Yeah, so I mean,
receptionist or something.
We do have like office professionals. We can have employees that way. We can eventually you grow your business enough where you could bring on another advisor to handle some of your clientele.
Sure.
If you wanted to.
So like you could have gotten hired on and worked with somebody else too and not been necessarily your own boss, right? Or you could have gone, so you kind of have like an option either way, I assume?
Yeah. And that's what some advisors do. They'll do what's called, at least in Thrivent, it's called a team-sponsored launch where they're kind of an employee of that advisor for a while they build up their clientele and then eventually they're on their own.
Sure. Okay. Well, cool. I think a lot of people I question these things because I feel like I know we've got some notes here on how I want to go about this, but some people have a bad rap on like financial advising, right? Like some people are like, life insurance, and these are all things we're going to talk about today. But I like understanding like the business aspect, and you as a business owner, it's not just Thrivent, it's not just like, so I just like to kind of put all the pieces together. But if we were to try to knock the domino down right away, why does like this field sometimes get a bad rap? Like what are the things that you see, or like what are the concerns that the general consumer might be saying? Like, I don't know. Everybody believes in like a Roth or a retirement or 401k, but some people think giving my money to this individual and managing it, like just it's money, right? So they're kind of whatever.
There are some, I mean, it depends on the individual or sometimes the organization where there's, sometimes different products get pushed more than others. And it's instead of listening to the client, what they're looking for. Just because I think you need life insurance doesn't mean we position that for you. So, and sometimes that turns some people off. And then people also think like, well, I can go online and do this myself. I don't need an advisor to do this. So why would I pay a fee to you when I could just go online and do my own investments? So that's where I think people feel like, I can just do it all myself. So
what is your take on like people who do it themselves online? I feel like there's probably a percentage of people who could probably do it pretty well, but I think there's a large percentage of people that could use some advising before making big decisions like that or knowing what they're talking about. So when people do have that argument with you, is there something that you're kind of like, do you have a sales pitch or like a,
Yeah, and partly people do stuff on their own. Like they'll work with me and they'll have their own investments on their own. Like they might, hey, I like to play in whatever crypto or whatever they want to play with that, then that's fine. But some of the key things they'll stick with an advisor. But they got to be able to work with someone that they trust. That's not just trying to sell them a product but it's going to listen to what their needs are, what their goals are. And you also want them to challenge you a little bit too, though. So, just because I use the example, somebody's making $40,000 a year and they go out and buy an $80,000 truck. That's not a good use of your money, and I'm going to challenge you on that. That's not a good purchase.
Yeah, agreed. I think that's a good way to put it too. It's like the general person who just like walks into any specific financial advising firm. Like if you don't necessarily know the person, it's like going to a random like used car salesman or whatever, too. It's like, well, their best interest is to sell you a car, and you know what I mean? So I think that's a big thing for anybody listening would be to make sure you've got like some rapport and you've built up a relationship, or at least know, or if you're going to work with an advisor, get referred in, you know what I mean? Like something like that, where don't just go off the street and go to whatever firm, right? So just bouncing off, trust the person you're working with. Don't just hand over your money. And also like what you said is like, you're not really trying to sell them on things they don't need. It's like actually understanding the individual and making sure like those people, when you're going to sit down with a financial advisor, make sure that that's how they're acting. Like, I don't need to sell you on everything. Let's make sure I understand your image and like help give you some options. But if you have a financial advisor that's really pushy about a certain thing, there might be more, there's commissions involved in that kind of stuff, right? So, and I don't think we need to like hide that stuff. Like people understand in the financial advisor firm, there are commissions that come from certain things. Absolutely. And then the other thing is sometimes, we'll meet with people on referral. So it's somebody I've never met before. And, they might come in, we might meet, and maybe they don't like me or I don't like them, and we don't mesh, so we don't work together. So that's totally fine. So it doesn't have to be, maybe they're a better fit for somebody else. So it's okay to have that meeting and say, you know what, maybe we don't need to work together. So that works well too. I like it. Yeah. So I think that's a good amount of, let's see if I had any other questions here before we dive into the topics. I think that's a good amount of background on financial advising and kind of where you're at. So let's start from the top. So when is the best time to start investing? This is something I always talk about too, but there's a lot of people listening. I think they need to understand like let's hear your spiel on when's the best time to start investing? Yesterday, always. Right. That's, a typical answer, like just as soon as possible. Just that compounding of interest over time is a huge deal. So even if you can only put a small amount away now, especially people, their teens or 20s, just starting to work, that just $50 a month, it makes a huge difference. I can give you an example with my son, Oliver. This summer, he had to stop down at the office for something. So he came down and I'm like, hey, we'll have a little meeting. We'll look at your policies. He's got an UTMA account, which is a uniform transfer to minors account. We can use that money for anything. We could have used it to pay for the braces he's got in his mouth right now, but we didn't. And we talked about, hey, year and a half, you're going to be 16. What if we took some of this money out and bought a car with it? And so I did a projection for it. Let's just say we never touch that money. You're just putting $50 a month in there. It's earning 8% interest based off of what it's at right now. That money, by the time he's 60, would be worth $1.3 million. Then I showed it, hey, what if we took that $10,000 out when you're 16 and bought you a car and still continue to fund that account, earn 8% interest? That $1.3 million turns into $950,000. So that $10,000 car would end up costing him about $350,000. That's crazy. So just to illustrate the time value of money. I think that, and one of the biggest things I talk about a lot on this podcast is like forward thinking, future thinking. Like obviously I do talk a little bit about finances, but I'm talking about fitness and making the right decisions now for the later game, right? Like what's it going to be like when we're 60, 70, 80? Can we function? And finances plays a massive role in that too. Like if we're not thinking about all of these different avenues for the future, it can, it's going to be tough. So super. When you do those like graphics and when you really look at it, it just really breaks it down and helps you understand and visualize how crazy it can be. Yep. And so his response was,
I hope Dad gets a new truck, so then I could just take his truck, and he would never have to take that money out. So that's his plan right now. Is like, well, somehow Mom and Dad are going to pay for this.
Sounds about right. Okay, so we should have started yesterday, but the next best day is probably today to start. So we kind of already talked about it, but if I wanted to start today, and we can take this so many different routes, but is there like one thing that like everybody should start with? Like, what's the easiest thing that everybody, if I was like, I'm going to start today, I don't have time to meet Jim, but what can I do today? Like, what is that first thing that you would say? This is the easiest. You can do it on your own. Let's do it, you know?
A Roth IRA is probably the easiest to start. It's one that especially younger people are most familiar with. That is something really easy to set up online. If you have any kind of, I guess, computer type skills, you can do it online yourself. Sure. But yeah, starting today, that would be the easiest to set up. But there's other key parts. Obviously you want we'll get into it later too, but like the life insurance and pieces like that. But for the average person, Roth IRA is pretty easy to set up.
Would you say no matter your age that a Roth, like let's just talk a little bit about like a Roth IRA, because I feel like that is one that a lot of people know about. If I'm 55 or I'm 25, like is a Roth still a really good tool to use at that point, or what's your take?
Most of the time, yes. I can't think of many examples where it doesn't make sense to do a Roth. But yeah, typically I will run into people probably in their later 50s, 60s that never had a Roth set up, just because they came out in the 90s and they just were already into traditional IRAs, so they never did a Roth. Okay. But yeah, for the most part, it does make sense, and partly because it grows tax-free. You can take money out of it without being penalized. So money that you put in, you can take out tax-free, penalty-free. It's the growth that you don't want to touch until you're, say, 59 and a half. Then it's all yours. You can take it all out at any time. It does not count as income to you. So versus, say, a traditional IRA, if you're to take money out of that, it's going to be taxed. You may get premature distribution if you take it out before 59 and a half. So there's a lot of benefits of a Roth over a traditional IRA. But like I said, typically a Roth is a better option.
And so for those listening, like the Roth, either of the, any IRA, both of those, I assume, I don't know much about a traditional, but they're both invested like in the market. What does that look like?
You can invest it any way you want. You could put it into, say, a savings account, a money market account. But you depending on where you invest it, you can buy crypto. You can buy, you get into mutual funds. Like with Thrivent, it would be mutual funds. And you can be very aggressive. You can be very conservative. If you wanted to get into large cap companies, you can get into that kind of stuff. So yeah, and Roth or traditional, they could be invested the exact same way.
Sure. Okay. So depending on how risky you want to get, that kind of would determine what that's going to go into, right? Like if you want to go in crypto, it's probably going to be a little bit more risk involved just because of volatility or something like that. And then if you want to go really easy, it'd be like some kind of money market or high yield savings where it's not necessarily, right?
Correct.
Okay. So the one thing that I was thinking of too, and we can talk about it because I just mentioned it and I talk about this all the time, is the high yield savings. Like I feel like that's another very easy tool that everybody should probably utilize. What's your take on a high yield savings and how to use that?
I would certainly use that as an emergency fund type of money, where some people's banks, they do offer high yield savings. I just met with a gentleman yesterday. His savings account was paying 3.5%. We were just having a conversation about, hey, let's move it from your savings to a money market that was paying about 4%. Until he showed me his savings account was paying him 3.5%. I'm like, well, this doesn't make sense to move it out of your savings account. You're getting 3.5%. I see that money market is going to go down, especially if the Fed cuts rates like they're talking in the near future. So, keeping it in his high yield savings is really good. But yeah, money markets do make sense. Most banks are paying 0.1% or 0.25%. Money market would beat that pretty handily right now. But just to have, say, that emergency fund, general guidelines is 3 to 6 months. Some people have a year's worth. Some people, they don't have a week's worth of savings. So it's good to at least get started, like get to that first month and build on from that.
What I like to coach and so like, before I forget, what is the max amount right now that you can put into a Roth IRA?
So $7,000 per year. If you're over 50, you can do $8,000 per year. So that's Roth or a traditional IRA. Those are the same limits.
And that's changed a little bit as of recently? Like it's increased over time, right?
It has increased. So Roth IRA came out in 1998. The max you can put in was $2,000. And that's increased over time. Not every single year, but when it does go up, it's usually by about $500. So in the near future, it might be $7,500, and then it might be $8,000.
Sure.
So they haven't decreased it ever, but doesn't mean they couldn't. But
one of the things that I talk a little bit about on the podcast when I do talk about finances. The way I like to utilize my high yield savings is because I'm not. If we're just talking very like basic, easy, I would say having a Roth IRA and having some kind of like automatic deposit going there is probably a great idea for the general person. The way I like to utilize like a high yield savings would be or the way that I coach on it would be to get used to money leaving your account and going there, and then kind of figure out your investments from there. So if you do want to work with a financial advisor and do a Roth, if you do want to, one, it's a great emergency fund, but then two, it's always growing. So if there's people listening and you only do, you do put money into your Roth, say right at the end of the year or something for like a tax write-off, or not a tax write-off, but like kind of end of year before the cutoff is for like the Roth IRA investments, like at least we've got money set aside, and then I can kind of utilize. You know what I'm saying?
Yep.
I like to use it as that kind of tool. So I call it like a sweep account. So my money comes into like a checking account. It gets moved over into the high yield savings before I can really touch it or see it. And then from there, I like to kind of make my investments, whether that be, like a Roth or whatever, right? Like that's how I like to coach on it, at least. I think it's a fine way to utilize it, but.
Yeah, that makes a lot of sense too. Just to, like you said, like, hey, get it out of that account, where if it's like in a checking account that, hey, I see that in there. It's like, oh, I got that money. I can go spend it on something.
Right.
So, and you kind of, you talk about it could be automatic. I mean, for most people, making it automatic, like a lot of our payments are automatic. So should your investments. A lot of times is every month so much is coming out of the account.
Right.
And a lot of times, people might see it come out of their account, but they don't really feel it. It's not like I'm writing that check or handing the cash over to to pay those either investments or insurances.
Yeah. That's actually a good thing to think about. I've never put like, we're used to all of these minuses in our account, or what is that, credit, debit? Is it when our account loses money and it's going to our insurance or it's going to our phone bill? We're used to that, but we should really get used to also like us losing like that money going to, we're always spending the money, but thinking about like the investing the money, right? Like just getting used to that. I'm just like, it's kind of clicking in my head that we should be used to seeing that minus 100 every week or month or whatever it is for our investments as well. So yeah, I like to utilize it like that. I like to kind of just use that as a sweep. Because I was going to say, for those of you who maybe, I think everybody as a base level should be just doing like an automatic deposit, high yield savings, Roth IRA, whatever you guys are doing, which obviously we're going to dive deeper into this. But if you can get used to, or what I was going to say, so with like a Roth that might be invested in the market, if you're paying attention to your Roth, if you're doing it on your own, if you're working with a financial advisor, sometimes there's, sometimes you can't always win, but like trying to watch the market, right? And watch it go down and try to buy at a lower time, right? Like that's like a strategic way to try to do it. Like again, you can't always win, you can't always beat the market or whatever, but if we are putting money in a high yield savings before we make our investment, and if you're not doing an automatic investment in your Roth, you can pull up some of that money and then kind of strategically maybe, right? Like how can you explain that a little bit?
Yeah, especially if you're following the market, you can, you may have heard of buying on the dip. All of a sudden the market, April this year, market went down pretty quickly. That was a great buying opportunity. And it's funny because people operate, with their investments totally opposite of how they shop. When we shop, we want to buy stuff on sale. But with our investments, so many people like to buy the things when they're expensive. They want to buy that hot stock when it's going up versus when it's on sale. If a stock goes down 25%, that means it's at a 25% discount. So Many people don't operate that way, but yeah, like you said, if that's the way you're gonna do that, kind of, hey, I have that there, and then, hey, I see an opportunity come about, then I'm gonna put a bunch into my Roth or wherever it is.
Right.
Yeah, that is certainly a way you could do it, but for the vast majority of people, making it automatic
100%
is going to be the best way to do it.
Yeah.
I mean, because it's, when the stock is expensive, you're not going to buy as many shares. When it's cheap, you're going to buy more shares when that money's going in. Again, like I said, you don't miss that money when it's coming out. You say it's a minus sign. Yeah, it's a minus sign out of your, say, checking or savings account, but it's just being relocated. It's still being invested. It's not like it's gone forever.
Right. And I think it's important to note too that this is a long-term game. So again, some people might try to do this strategic buy at the low and sell at whatever in the stock market. But like Jim says, the consistent $50 a month, $100 a month, whatever that, it's the long-term compound. It's the, maybe in 2024 we lost more money, but 2025, so it's that when we're 60, not when we're 25 or 30. It's not that short-term win. It's that gain over time, really. So that's the most important thing to do. So having some kind of automatic withdrawal, even if it's a bare minimum, so we don't have to dive too much deeper into that, but yes, having some kind of automatic withdrawal, I think, is by far the safest thing. Consistency, you don't accidentally spend that money, all that kind of stuff, right?
Yeah, absolutely. And it's, like I said, it's easy to say, well, I got this big bill coming up this month, so I can't put into my Roth. I can't afford to do that. If it's automatic, you don't even think about it. Think of all the bills that you have automatically coming out that you don't think at balking at it. Like, oh, I'm not going to pay it this month because I got this big bill.
Yeah. And then just having your emergency fund. I feel like that's something that we probably, I think people need to realize how important an emergency fund really is, because you don't know when life's going to just, rain, right? You just don't know when something is going to happen. And I mean, it can be anything. You can have a car issue, you can have a house issue, you can have whatever, just a basic flat tire, all of these things that just happen, and you don't wake up thinking, I can't wait to get a flat tire today. You're not, but it happens, right? So I think a lot of people, I don't know, I mean, I doubt you know the statistic either, but it's a very low percentage on people who actually have a decent amount of money saved and set aside, especially an emergency fund. I know I see random statistics. The average 25-year-old has less than $2,000, or whatever that number is. I'm not sure what it is, but I can imagine in your field, there's probably a good amount of people that you meet, maybe, that haven't even thought about emergency funds, or people that maybe you're talking to people my age that, you know what I mean? The emergency fund is very, very important. I don't think a lot of people talk about the Roth, but the emergency fund is an important aspect, right?
Absolutely. And I've had a lot of scenarios where people have called me and they did dip, or they had an emergency fund. When people call me, hey, my dog tore its ACL, so I need $5,000 for the surgery. That is, not something you budget for.
Right.
You don't plan for that. One unfortunate situation where I had a guy moved into an apartment, was going to hang a TV on the wall. So he got his stud finder out, located the stud, starts drilling that stud. Turns out that stud was a water pipe for the sprinkler system for the apartment complex. So he ends up getting all this water damage. He's on the hook for $6,000 to pay for the damages. He didn't have an emergency fund. So we ended up dipping into his Roth to make that payment. Fortunately, he did have enough contributions, so it wasn't a tax liability for him. But that just stresses that, hey, really, a Roth IRA, and I didn't even say IRA, people don't realize that's individual retirement account. So it's meant for retirement. So we'd like to keep it at that. But yeah, there are cases where you do have to dip into it, or you can dip into it.
Yeah, I'm just thinking about that story. That would be horrible. You just try to be a handy guy and do it yourself. I mean, how would you even know? I don't know. I'm not necessarily a handy guy. How would you know stud versus a water pipe of some sort or whatever was going on? But that is yes. So emergency funds. If you're listening and don't have any kind of emergency fund, big recommendation there. I guess it's kind of is the note. So let's talk about. Let's see here. You've got a note here, so I'm going to bounce around a little bit more. Let's talk about I mean, the favorite thing I like to talk about is like life policies, but yeah, let's go into that. Let's go into life insurance. Maybe talk about the different kinds of life insurance. I think that's one of those things that a lot of the general public, I don't think knows enough about or knows the differences and that kind of stuff. So let's just talk about life insurance. You take it from the top and kind of wherever we want to go with that.
Sure. There's two kinds. I mean, two basic kinds. There's term insurance and there's types of permanent insurance. You'll hear of whole life, universal life, variable universal life. The biggest difference is term insurance. You can think of it as your car insurance. Okay, you don't smash up your car, the insurance company doesn't pay you any money. Term insurance, same way. You don't pass away, nobody gets paid any money. So it's very cheap for because it the likelihood of it paying out is very low. But then there's that permanent insurance, like say a whole life policy, where there's cash that's built up in there that you can use for various reasons, whether it's you build it up and you can use it as a down payment on a house or a car, or there's several uses for it. The permanent insurance is very misunderstood, and there's a place for both. Like for myself, I have a lot of term insurance on myself, just because I think if something were to happen to me today, I got 3 kids. They're all 16, 14, and 10, and they're dependent on me bringing in the money. So if I'm not there to do that, there's some term insurance there to help offset that expense. So because it is much cheaper than permanent insurance. But people look at the premium for a permanent policy, and it is higher, but you also have that cash that's built up in there, and over time that cash can be more than what you even put into it. So there's a lot of uses to it.
So the term insurance, to keep it simple, is for a certain term, right? Like it's like you compared it to car insurance. If you don't wreck your car, you don't get paid out. And if so the term insurance, and I don't know much about term insurance, but it's when you sign up for it, if Jim signs up for it today, are you signing up for is it a certain term, like a 3-year, 5-year, and then it expires and then there's no cash value, right? Like let's break down the basics so everybody.
Yeah, so term insurance could, at least with Thrivent, you can do 10, 20, or 10, 15, 20, or 30-year term. So you are locked in at that rate. So if I get approved for, say, $1 million at $100 a month. So for 30 years, I could be paying that $100 every single month. It won't go up on me in the meantime. So, and at least with Thrivent, we do have a term conversion option where if I want to, at any point, I can convert some of my term insurance into a permanent policy. I could say I want to convert $100,000 to a whole life policy. I could do that. I don't have to prove that I'm insurable again. So once I get it go through the medical underwriting, then I'm set for the length of that term. So I can get approved today, and then tomorrow I become uninsurable, or I become very expensive because I get diagnosed with some kind of illness, and then I can't get it.
Sure. That's what I was going to say too. So depending on your age, your health status, all of these things play a factor in how much that term insurance is really going to cost, right? So if I was 27 and I want to get term insurance and I'm in great peak performance, whatever, I would have a much lower rate that I could get locked in for a long time. But if Jim comes in and he's 50 and he's a chain smoker or whatever, I mean, those things are going to show up. Your age, your weight, all those things are going to affect that price, right?
Yeah, absolutely. Because for the most part, any kind of insurance is going to care about two things. It's your age and your health. So the younger you are, the cheaper you are. The healthier you are, the cheaper you are to get insured. So a lot of times people think, especially say people around your age, it's like, I'm single, I don't, living in mom and dad's house. I don't have a lot of expenses. No one's dependent on me, but it's to protect your future insurability. So
Sure.
That's where it makes sense. Even if the need isn't great right now, but in the future, it may be,
So that's my question. For those listening, when do I want term insurance, or when do I want to think about wanting term? Obviously, again, when age is on your side, it's not a bad thing to do, because it might be $25 a month or something really cheap. I don't know if that's a good number to use, but when might I want to think about it? Like, I know you're going to tell me right now that I should already think about it because, again, it's my future. But, if I'm 50 and I've got kids, just what are some scenarios that are really good for term? You know what I mean?
Yeah, good. If you don't have it in place, when you get married, you buy a house, you have another kid, those are good times to probably relook at what you have, because some people might have something through their employer. But it's also good to have it, something on top of that, add another kid to the family. You look at some of the statistics, I think to raise a kid from 0 to 18, last I saw was like $250,000. So do you have enough there to cover the raising of that child?
Got it. So we kind of understand term insurance now. It's kind of like a use it or lose it policy, basically. I think it's an easy way the only way you use it is if you're gone, and otherwise you lose it, right? So we shift over to like a whole life or there's all these different terms and ways that whole like life insurance is talked about on the other side. So that can be invested in the market somehow as well on like those policies, right?
Yeah. So if you get into a variable universal life policy, that can be invested in mutual funds. So say your premium is whatever, $500 a month. Part of that money is going to pay for the cost of insurance, meaning that if you pass away, the insurance company is on the hook to pay that death benefit to whoever your beneficiaries are. So you pay that $500 a month. Not all $500 is going to get invested, say. So you can pick, I want to be aggressively invested in this, and you can. So say you put $500 in, and I'm just making up these numbers, so I don't know for sure. Say $500 you put in, $100 goes for the cost of insurance. The other $400 gets invested, however you choose. But then that money down the road can be used for whatever it is. Could be, retirement. You can start taking income from that.
So like these life policies, they build up what we call a cash value, and that cash value is what I can take out, or right? I mean,
yeah, the cash value you can take out of it, and like you said, those investment pieces. That is an investment, so it can lose value over time too. So it's just like investing, your Roth IRA. You could lose money. You can put, say, $10,000 in, and it might be worth $9,000 at some point. But over an extended period of time, typically that goes up.
And there's different. So again, there's different variable universal. There's there's these different things, and some of them are less risky, and some are more risky, right? Like depending on, I don't know, like a whole life maybe is less risky, less gain than, I don't know.
There's more guarantees in a whole life. Any whole life policy, you're going to have some, growth of the cash value at a very steady rate. Like Thrivent will pay a dividend. They have. There's no guarantee to that, but they've paid it for the last 110 years. They've paid a dividend. So sometimes people look at that as that's kind of their conservative investment, where, hey, I could be really aggressive over here with my Roth, but maybe my life insurance policy is a whole life. It's got some very steady gains, or even in a down market, that's going to continue to grow.
Makes sense. So just very brief, who would want to maybe look into like those kinds of it? Like when would be a good time to look into like a whole life, or who do you recommend that to? I know Roth is like up there, emergency funds. When would it be like a good time to think about maybe a policy like this?
A lot of it depends on your income. If you have your other bases covered, you have the emergency fund, you're maxing out a Roth IRA, you got enough term insurance. One we haven't talked about is like you have like some kind of income protection covered. Then maybe, if there's surplus there, then maybe we look at moving maybe some of your term insurance over to a permanent policy. But that's kind of like, if you're really financially stable, then maybe we start adding that piece to your overall plan. Understood.
Well, let's talk about the income protection aspect. So this sounds like one of the other bases that it's very important to think about covering. So tell me about that.
Yeah, absolutely. And it's very overlooked, especially people like your age, because young, fit, strong, like, hey, nothing's going to happen to me. Or if it does, I can fight through it. But it's there to protect you. If you get sick, you get injured, and you can't go to work, this will provide you a paycheck, every month, so that you can continue to pay your rent or pay your mortgage, make your car payments, keep the lights on at your home or apartment. Well, you can focus on getting better. So now you're not concerned about those things, because that's taken care of. I got money coming in to pay those bills. now I can focus all my energy on to recovering from whatever it is.
And so this is like disability insurance then?
Yeah, it'd be disability insurance, or if you have it through an employer, sometimes they call it income continuation, or some version of that. But and another thing is, it's always nice to have something outside of work. The average career lasts about 4 years, meaning that people go from job to job to job throughout their working career, and some people are going to work at a place that has great benefits. There's everything there, and they might go to a place where there's no benefits. And so it's really nice to have a policy outside of work that's transportable. So no matter where you are working, you at least have some protection there.
That makes sense. So the young people tend to overlook that, and it's probably something that everybody, so the question is, who needs it? This should be something that everybody should be thinking about, really. It's one of your main bases that in the financial advisor industry, it's like, hey, we should probably get this going for you, like ASAP, yeah?
Absolutely. And especially for single people, that is kind of like their biggest, risk to them. If you're a single person living at home, or on your own, you got your own apartment, what happens if you no longer can earn a paycheck? You don't have a spouse or someone that can, hey, pick up an extra job or cover those expenses for you. It's all on you, so your income is what's providing everything for you. So especially if, the emergency fund is only, 3 to 6 months and you have something longer term, that could be, medical expenses are the biggest cause of bankruptcy in the U.S.
Interesting. So when I sign up for, if I were to get disability insurance, so where my mind's going is like, what if I lose my job and then I happen to, because this is like, if you get hurt, this isn't getting hurt at work. This is getting hurt whenever. This is a freak accident. Didn't understand it. So if I have a job today and I sign up for disability insurance with a firm similar to yours, how do you go about, if I'm getting paid X dollars a month, like, hey, I'm making $5,000 a month at my job currently. Is that a figure that we take into effect over when we do this type of insurance?
Absolutely. So we'll look at what your income is, and typically they'll get you close to about 80%.
Okay.
They'll never make you say whole. Like if you're making $5,000 a month, disability insurance typically doesn't get you to $5,000 a month. It might get you to about $4,000 a month. And they'll look at, what is your occupation class? If your job is very physical, they don't look at necessarily how dangerous your job is, but what does it take physically to do your job? If I do a desk job, for me to get back to work is, physically, I break my leg, I can still work.
Right.
If you're, say, a lineman, you break your leg, it's pretty hard for you to climb up and down poles with a broken leg.
True. So like if I were to become unemployed, let's say, for 2-3 months, and then I also hurt, I'm just curious, if I hurt myself then, I'm still obviously covered at that same rate that how does that play in effect? Yeah,
if you have that policy in place, that's there for you.
So, and it won't change if I go from job to job to job and I sign up for, do you guys ever re-audit what that monthly income looks like or anything like that to adjust the rates at all? Again, if I go from making $5,000 a month to $3,000 a month, I took a new job, how does that work,
You can typically, you look at it in the positive light, like, hey, I went from $3,000 a month to $5,000 a month. Depending on how the policy was written, you could increase the coverage that you have. Typically, we haven't decreased it.
Yeah, I was just curious.
But we have done, occupation class change, which means I had a client that went from working in a factory, they're paying a higher premium because their job was very physical, to working an office job. We were able to lower that person's premium because their job became less
demanding.
Yeah.
All right, so just checking notes here too. I see you've got something, retirement savings benchmarks. Let's talk. Tell me about what this is.
That's something I wish was around, or people mentioned it, when I was growing up, because you never, I started saving money into a 403B when I started teaching. Put $50 a check in. I had no idea if I was on track or if I was doing enough or too much. But a benchmark is by the time you're 30, you want about 1 times your income in a retirement savings account or multiple savings accounts. So for example, if you make $50,000 a year, by the time you're 30, you want about $50,000 in retirement savings. By the time you're 40, you want that to be about 3 times. And then get to age 50, you want it to be 6 times. So if you're making $50,000, you want $300,000 in retirement accounts. And then from 50 to 60, you need it to be about 8 times. And those are good numbers to look at. And a lot of times, especially working with the younger crowd, people will be in their 20s or even 30s, and it's like they're not quite there yet. It's, they feel like, oh, I'm behind, but it's pretty, I want to say it's pretty easy to catch up, especially if you're doing it early on, because of that compounding interest. So even if, you're 20 some years old and you only got a few $1,000s in a Roth, that's going to make a difference over an extended period of time.
Interesting. Yeah, I've never thought about it like that, but that's it's kind of like a good goal to think about. I think a lot of people just kind of go around aimlessly, like saving and maybe kind of saving, but having some targets, for later in life, like, hey, I should be trying to save up this or that to really help with retirement, right? Like, hey, I've got enough when I do want to retire, generally speaking. So, no, that's cool. That is something I have not thought about. Let's talk about this is something that I always think about with our team and stuff. So the 401ks, the employer retirement plans, I don't know a lot about that stuff, and I think that is probably something that a lot of people listening have access to, maybe are utilizing. But I think a lot of these, in my opinion, a lot of these plans sometimes are in the employer's best interest, right? Like, because I could lock Jim into working with me for 3 years in order to get at, to keep these funds. And so I just know there's like pros and cons, and understanding as the consumer aspect, I think, is important. I don't really know anything. I've heard some things. So I guess tell me what you've got on those plans. Yeah,
different retirement plans. You work for an employer, they'll, a lot of them offer a 401k or 457, 403b. They're all pretty similar. Basically, you put in a percentage, they're going to match up to a certain percentage. So a lot of typical ones is like, if you put in 6%, they're going to match 3%. So you put in $100, they'll put in $50. We always recommend if it fits your budget, take the match, because we can't beat free money anywhere. So, but yeah, like to your point, sometimes the employer, locks you in where you have to be vested, where you have to work here for 5 years before you get the full amount of what they contributed. So you always get what you put into it. Yep. So I put in $100 a month every month that I work there. I might, I leave, I get all of that money, but maybe I only get 10 or 20 or 30 or 50% of what the employer matched, depending on the length I stayed at the organization. But a lot of time, it's always nice because, like you said, people will change from job to job, and then they can move those 401k dollars to an account outside of their employer. So then they can take control of it. So it's not necessarily locked up with that employer.
So what is a 401k? Like, how is it? How are these plans? What are they invested in the market? Like, I really know nothing about how they operate. So
yeah, a lot of times it's whoever the company works with. Sometimes it could be any financial organization they want to work with. You are somewhat limited on the funds that they have to offer. So whatever that employer offers, those are your choices. But again, you can be very aggressive, very conservative with it. But it's helpful to talk with an advisor. A lot of times they'll have a representative come in and talk with the employees and help give them some guidance. Sometimes I have people come in and say, hey, I got this 401k option. What do I do? Like, how do I decide, should I do Roth? Should I do traditional? Do they offer both of them?
Sure.
So we do sit down with people and have that conversation with them.
So these plans that we're talking about, I can't start one on my own, right? Like, is there a 401k that I can just go online right now and do, or is this traditionally offered by an employer and I wouldn't want to do it on my own? I'm just curious.
Yeah, I don't know if you'd want to do it on your own. I mean, unless as an employer, you could do that. You could set up a 401k for your employees.
Yeah.
But yeah, typically you just do a traditional IRA or a Roth IRA on your own.
But so like a general individual, like one of my employees, they wouldn't necessarily want to go out and just like start up their own 401k. Like, that wouldn't make a whole lot of sense.
No.
So I'm trying to think if there any, I can touch this money, I can't touch this money at a certain age, like tax benefits, like what is like that aspect of like these plans as well?
They're going to operate just like your Roth IRA or traditional IRAs, where 59 and a half is kind of the magic age where you can access the full amount. So and some traditional IRA or traditional 401k is going to grow tax deferred, meaning it goes in pre-tax. You didn't pay any taxes on it. You're going to take it out and you're going to pay taxes on it. Where a Roth 401k, you pay taxes on it going in, and it comes out tax free.
So if I were to have some takeaways like regarding a 401k, the first thing you said was you can't beat free money. So if the employer is going to give you a certain percentage match, like you should take it because it's free money. And then at least put in that, if they're willing to match up to 3%, at least put in 3% or 6% or whatever the ratio is. And then the other kind of takeaway that I guess I'm getting if I was an employee would be to find somebody who knows how to read about these plans a little bit more. Like I would want to connect with, whether it's a financial advisor or somebody who's gone through like these types of programs in general, to just understand what's happening with this plan. Because I do feel like there's like these little, I think it's important for the employee to know, like, hey, if you're not here for the full 3 years, you're only getting, and that's usually probably pretty straightforward, black and white, but I think there's just like these little caveats maybe sometimes to these plans that the employer can build in that I think, maybe I'm wrong, but I would want to talk to somebody about it if I was going to start doing it, investing in it, I guess is my aspect.
Yeah, it's understanding it, because a lot of employers will say, hey, you have to be here for 6 months or a year before you can even start contributing to this 401k plan. So yeah, and you're just understanding what is they call it the vesting schedule. All right, if I'm here for, some might do 10% per year, so you got to work there for 10 years before you'd be 100% vested with that, with their portion of it.
Sure.
But and I think you brought up the other point about like possibly taking money out of there. Had a conversation the other day with a client that he incurred a bunch of medical bills. He had something happen. Didn't have insurance at the time, so now he's got these huge medical bills. He's talking about, maybe do I dip into this old 401k to help pay it off? And we talked about, you're going to pay taxes on that. You're going to pay a premature distribution on it. So is it worth it or not? So it's something that we're going to dive deeper into, but maybe it makes sense for him. I don't, we'll see.
Fair enough. Definitely those plans, like set it and leave it, utilize it. If your employer is willing to give you some kind of match, utilize it, because nothing beats free money. So, okay, let's see if we've got anything else. Is there anything else that's coming to mind before we hop into? We've got some tools I know that you wanted to share with us that you've got here. Is there anything else before we get into that aspect that you wanted to cover, touch base on?
No, just I'd say for individuals starting out, probably the top 4 things they want to have in place: emergency fund, Roth IRA, some kind of life insurance outside of work, and disability insurance outside of work.
Okay. Those
are kind of the top 4.
The important takeaways that everybody should be set up with.
Yeah.
And that's right out of the gate. 18, 19, 20, work on getting those things kind of, we're always talking to the younger individuals, me being one of them. It's like, you're invincible. You can't get hurt. You can save money later. I'm not worried about it now. I don't have a house. I don't have kids, right? These are our mindsets then, but thinking again, forward future thinking, we're thinking at that 45, 55, 65 retirement. It's better to think about that now while it's in our advantage to start that stuff, right? That's the biggest thing.
Absolutely. And it's, people can put it off for an extended period of time just because nothing bad happens immediately. Like, if I waited till next month, no big deal. I didn't start saving yet. I'll wait till next month or next year. And then all of a sudden it's, hey, you're 40 years old and it's like, I didn't save anything yet. So now you're in trouble.
That's one of the things I talk about on the podcast too, is we're, us humans, we're always thinking January 1st, next Monday, after this weekend, or, we're always thinking in anything that we want to start doing that we know we should start doing. It's always like that. Well, yeah, Monday because it's like a fresh slate, or January 1st because it's a fresh slate, or next month, or exactly what you're saying. And so I talk about it in the health aspect. I talk about reading. If we want to start something, let's just write it down and let's start it. Let's do it. Let's figure it out. Let's make a game plan, because it's easy to say next week, even when it's Monday. It's easier to say next Monday or by Friday or whatever. So I think that's something smart to think about. Okay, so we're going to finish up with today's episode. I know you've got some tools that you wanted to share with us that you like to use. So let's dive into those, and then we'll get it wrapped up.
Yeah, so one tool we use is Money Guide Pro, which is where we'll gather, your financial assets. So wherever, we got 401ks here, savings accounts here and there, we'll gather that all in and give you kind of a comprehensive view of what you're looking at. And one that coincides with that is our Thrivent planning platform, which is unique to us, where we can take all that information from Money Guide Pro and look at your financial situation, your goals, and find any gaps. Like, hey, we got all this stuff in place, but we're missing this, and we help put that together. And it's really nice for a client to look at, and it's like you get basically a one-page snapshot of where you are financially, and it's very helpful for people to look at that and see that. Another tool that we use a lot, especially getting into this time of year where people are looking at doing Roth conversions, it's called a what if tax planning, where we can say, hey, if we convert $10,000 to a Roth this year, what is that going to do to me tax-wise? And then it also helps us avoid any surprises, tax-wise. We do this conversion, and then all of a sudden, we bumped up to the next tax bracket, and we're trying to avoid that. So that's where that tool helps us, gauge, how much are you going to pay in taxes? And then knowing, say, come next spring, hey, I'm going to owe about this much in taxes. So we are not tax planners, but we at least we know enough to be dangerous. But we always refer, like, talk to your tax advisor, because sometimes there might be information that you didn't share it all with us, and then all of a sudden something happens. So we always defer to your tax advisor on that as well. And then another one that I really like in talking about that, those general guidelines of having, like, by the time you're 30, you want 1 times your retirement savings there, is a future value calculator where we can take, here's where you're at now. If you continue putting this amount in, this is where you're going to be at. Or if you put in, if we increase it, maybe you're putting 100 a month in now, maybe we increase it to 250. What will that do to you future-wise? Will you have enough by the time you reach the retirement age that you want to retire at?
Yeah. And I think that, and I've already said it, but just really thinking about, like, the future and having a plan. And I just have so many friends that I know that are just, like, not focused, and it's not even focused. It's just, like, not thinking about all of that, just the future, just the day by day mentality, which I'm not trying to say, like, you should have your whole life planned out. Like, I don't say that's a great idea either. But when it comes to, like, health and your health and fitness, your diet, the things you're putting into your body, like we only have, like, I might have just said this on Holden's episode that got released today, but, like, our body is a car, right? If you only had one car the rest of your life, what would you put into it, right? How would you take care of it? Like, this is, like, the analogy that I like to think of. And so it also goes with, like, the knowledge you're putting into yourself. So, like, the books that you read and understanding, and it helps, again, that, not that car, but that body. So the same thing with, like, the finances. Like, we have to be thinking that long-term play. Like, when we're 65, 70, we're not as useful to society as far as to be able to make a lot of money very quickly, generally speaking, right? Like, we can't just go back out and do construction, and like we did back when we were 25 and we were making all that money, and then we decided to buy the $80,000 truck or whatever, right? So anyways, little minor rant, but really thinking about the future, I think, is, like, the most important thing when it comes to investing in finances. That's for sure, right?
Yeah, absolutely. And just, like, getting started early. Sometimes just having that conversation is the biggest thing, And sometimes a lot of times people are uncomfortable, especially if say they get to be in their 30s or 40s and they haven't done any planning. A lot of times they're embarrassed to come in and meet with us, and I don't want them to feel that way. It's like, I'm going to meet you where you're at, and I'm going to help you move forward. That's the goal. And when you're 19, 20 years old, you're a young person, just getting started.
Yeah.
Makes all the difference. And a lot of times if it is, you're fortunate enough to be staying at say mom and dad's house, you all your income can be used to starting a plan like this.
I love it. Well, I think, is there anything else that you want to touch on before we wrap up?
No, I think that was it.
Should be good.
Yeah.
Cool. Well, hopefully you guys enjoyed today's episode. We dove a little bit deeper into some of these investment ideas, strategies, things that we can do. I hope you guys have some questions. If you do, let us know so we can try to get some of those answered on a future podcast. I personally love finances, so I really enjoyed having you on today, Jim. It was great. I like to learn, so for me, this is actually like me learning stuff, and we're just creating content for everybody else to listen to, which is great. But hopefully you guys took something away from it. Hopefully you guys really actually absorb this and think about what you guys are doing in your day-to-day life and how you guys can put yourself in a better position to win, especially on the finance side of things. So hopefully you guys enjoyed it. Thank you, Jim, for coming on. If we have an opportunity to do another one in the future, I'd be more than happy to do that as well. And so thank you guys, and we will see you on the next one.